everyone. Welcome to You Just Got Your PPP Loan Proceeds, Now What webinar. We are really glad that you could join us this morning. So we've got a lot of content to get to, and we're going to go ahead and get started. But I wanted to let you guys have a few quick housekeeping items before we begin. So if you put your cursor to the bottom of your screen, you're going to go ahead and see a Q&A box. And go ahead and type your question in there. If you have any questions for Dave and Mark, please do note that we received quite a few questions beforehand from those of you who are registered. We will do our very best to answer all the questions that come in. We will actually stay after the webinar and continue answering questions as long as you would like to stay. Last item I wanted to let you know, this webinar will be recorded, so in case you have to leave early or you want to watch it again, we will be giving it to you in a recording link. So go ahead and look for an email in your inbox later today with the link to the recording and also the slides from the presentation today. So let's get started. I'm going to hand it over to you, Dave.
All right, thanks, Jill, and welcome everybody to this presentation. This is an exciting time right now in our country and in our economy and for you as a business owner, and we're going to try to help you and guide you through some of this murky water that we have before us. But before we get going, just want to introduce myself. My name's Dave Myers. I'm a tax partner at LSL, and I'll let Mark introduce himself.
Good morning, everybody. I'm Mark Zimmerman, and I'm a tax director at LSL.
All right, thanks, Mark. Before I go into the nitty-gritty, I just wanted to give you some context for this webinar. So every day, and I mean when I say every day we get additional bits of guidance that is coming out on the payroll Paycheck Protection Program loan, and it's some of it's good clarification, some of it is we think craziness, but just yesterday we had 2 new FAQs that were published, and this morning we had another interim final rule, another final. We keep getting added amounts of guidance, and so in context of what we're presenting, you just need to realize that this is very fluid, and there's going to be more to come. One thing you're going to find from this presentation is you're going to find that there's a lot of things that need to be answered, and we're not going to give you those answers. So it's going to be frustrating, but what we're going to try to do is give you the most important thing that you should be doing now, what we know is true and what you should be doing. At the end, we're going to talk about FAQ 31 and 37. Doesn't mean much to you, but I'm just going to tell you that those are bombshell guidance issued by the Treasury that we think you need to be really aware of, and that you should take some action on. So we'll get that at the end. Just want to let you know that we're going to cover that, but just keep in mind that there's going to be more guidance to come. We were expecting, Treasury is supposed to issue final guidance by April 26th on loan forgiveness, and we have virtually nothing on loan forgiveness right now. So we want to focus you on the most important things as we go forward. So let's jump into it. So some of you have already received your loan proceeds. Congratulations. Some of you are waiting in line. You had to wait for the second tranche to be approved. And but for those of you, at some point you're going to get loan proceeds, and that's going to be deposited into an account. And the first question you're going to have, do I have to maintain a separate account? And the answer is no. The SBA has not required you to maintain a separate account. Now, your bank, on the other hand, might want you to put it in a separate account. And the reasoning is that when you certified to get this loan, you certified that you were going to use the loan for payroll costs, for rent, for mortgage interest and utilities. And the bank might say you have to put it in this account. If you do, then that's fine. You also it might make it easier for you to trace the loan proceeds as you use it. But it doesn't do anything to minimize interest expense. And what do I mean by that? Let's say, for instance, you have a $500,000 loan proceeds, and you have a $500,000 line of credit that you're paying 5 or 6% on. Why? We believe that if you put the money in or pay down your line of credit, you're basically parking it there. It's just a cash management strategy. You're not paying the money outside your organization for inappropriate use. You're not, you're going to be waiting for 8 weeks to make expenditures. So why not pay down the line of credit? And the thought is money is fungible. So what dollars you're paying down and moving around, there's no requirements that you have to maintain an escrow type of account. So this seems to be lots of questions and a lot of controversy, but the bottom line is you need to expend the loan proceeds for payroll, rent, utilities, and mortgage interest, but it doesn't mean that you have to directly trace dollar for dollar to those costs. You need to maintain good accounting systems so that when it comes time to gathering the information, what did you spend on payroll costs? What did you spend on rent? That you'll need to have that. So next question that's probably coming to your mind is, what should I do with my employees? And we're going to say over and over, you need to hire your employees back as soon as possible and pay them as close as possible to what you were paying before the COVID crisis. And then it's like, well, my employees are staying at home. I don't feel like paying them to stay at home to do nothing. Is it really okay? And the answer is yes. And this is exactly what Congress wants you to do. Congress wants you to employ your employees. Most of Congress wants you to keep them off of the unemployment rolls. And that's why they're using the carrot of loan forgiveness to get you to do that. So why should I do that? First, Congress is picking up part of the cost. And then also, when you have your employees employed, and even though they're at home doing nothing, you're going to have them there. So when the economy turns, and the latest talk is the third quarter will be a transitional quarter still, and the fourth quarter should be when everything starts flying again. We don't know, but that's the latest predictions from the business leaders and the economists. So you want your employees there. You want your trained employees that know how to work in your system, ready for when the economy comes roaring back. And the other thing is, don't pay them to do nothing. So think about right now, everything that's like, I've been so busy in the last few years, and the economy's been going strong. I've been making a lot of money, but I really want to implement a new technology. I really want to train my employees to have better soft skills. I want to do some brainstorming sessions with employees to get their ideas on how to better our business. But you haven't had time to do it. Well, now you have an 8-week time to do something like that. So have your employees not do nothing, but use them to develop new technologies, to get things going. It's a great time to do it. So when should I hire back my employees? Well, I think I said from the beginning, now, as soon as possible, get them back. Now, there's a lot of confusion out there that if I hire them back by June 30th, so on June 29th, I go back and hire them all back, that I will have complete loan forgiveness. Well, hiring them back is good advice, but it's only part of the picture. So, so if you hire them back on June 29th and your 8-week payroll or 8-week forgiveness period ends on June 15th, how much of those hired back wages, payroll costs, are going to be included in your 8-week period? 0. So you might get 100% of 0 is the thought. So it's only part of the equation. So let's turn to that calculation and see why you would want to hire back or let's turn to the loan forgiveness calculation. So how is that calculated? And the answer is, this is going to really disappoint all of you. We don't know, and neither does anyone else. And so why are you on this webinar? Well, you need to hear the whole thing about hiring back your employees, but you also need to know what are the main sticking points. And then when we have further guidance at that time, we will have another one of these webinars. When we get guidance and so we can do exact calculations, we will come back and do this again. So as I said before, Treasury and SBA, we're supposed to have rules published by April 26, 2020. That was Sunday. That was in the CARES Act statute. They're late. So in general, the rule is, and this is from the statute, the CARES Act, the total eligible loan forgiveness is payroll costs, rent, utilities, and mortgage interest, and it's during an 8-week period. Your loan proceeds were calculated based on a 2.5-month period, but your forgiveness is based on an 8-week period. And when does that 8-week period start? The date your loan funds. When you put those loan proceeds in your bank account, it starts, the clock starts ticking. Some of you, it's ticking right now, so it's very important. Treasury and the SBA added this, and they've added a bunch of rules that are not in the Act, and we believe some of those are frustrating the purposes of the Act. But in this case, they added a 25%, your non-payroll costs. What are those? Rent, utilities, mortgage interest cannot be greater than 25% of the amount forgiven. So let's dig into that a little bit more. So that's the general rule, but it's not that simple. And as we find out in everything in this area, there are 2 limitations and an exception. The 2 limitations are a headcount limitation and a payroll cost limitation. The headcount is you take your headcount, which is full-time equivalents. We don't know whether full-time equivalent, if that's using a full-time of 30 hours, that would be what was in the Obamacare rules, or if it's 40 hours or 20 hours, we'll have to get guidance on that. But it's during the 8-week period, this forgiveness period, and then you compare that to a look-back period. That look-back period is either going to be February 15th of 2019 through June 30th of 2019, or January 1st of 2020 through February 29th of 2020. Then you compare this full-time equivalent. If it goes down, you have a ratio. So let's say your full-time equivalent during the 8-week period is 90% of what your your look back period is, then whatever your total forgiveness amount is, potential forgiveness amount, you would multiply that times 90%. So that's the first count, is a head count, and then the second is based on the pay rates or payroll costs, and this is on an employee by employee basis. So if an employee, if their pay rate goes down by greater than 25%, dollar for dollar, you reduce your potential loan forgiveness amount. So what's that based on, the 25%? It's based on the first quarter, the 8-week period compared to the first quarter of 2020. So we have all these look backs have different periods and different measurements. So this is based on the first quarter payroll of 2020. And you get to exclude from this calculation the amount of anybody that has made more than an annualized salary in 2019 of 100,000. There's a lot of, the way that's calculated we'll get into later, but that's based on a 2019 period, a payroll period. So if anybody has greater than an annualized salary of 100,000, you don't have to worry about, you could cut their pay as much as possible. You know, you're not gonna, that's not gonna dock you at all. So this shortfall reduces your forgiveness amount dollar for dollar. Okay, my head hurts, and I know mine does, and I know yours is hurting right now. So, but getting back to this 6/30/2020 exception, what is this and how does that work? So another period to think about. So between anybody that you laid off or furloughed between February 15th of 2020 and April 26th of 2020, and you restore them back by June 30th, you don't have to put them into that calculation to reduce the amount of loan forgiveness. And it sounds like, okay, if I just hire everybody back, like I said before, by June 29th, I'm not going to have to count that in the head count and the pay rate reduction amounts. And that's correct. Sounds simple, but it's not, again. So what about just to throw this out really quick, let's say you have an employee, you lay them off, and then because of the $600 a week unemployment compensation provision, plus California, maybe they're getting over $1,000 a week on unemployment. They're saying, I'm not coming back. I have a 39-week vacation, and I don't want to come back because I think I might get COVID. So you want to maximize forgiveness, so you go out and you replace them. Does that person, how do you handle that with the head count or with the pay rate cut? Is that person compared to the other employee, or do you get to count that person, the replacement, against the employee? We don't know. The other amount is the other issue, and I alluded to this, was this annualized pay rate of 100,000. And the issue is on that let's say you had an employee that you paid 50,000 was their salary, and then in the last week of December, you paid them a $10,000 bonus. So they made 60,000. So they're clearly under the 100,000, but on a weekly payroll, and that's the way the statute is written, it's annualized based on any pay period in 2019. If you annualize the 10,000 times 52, you're at 520,000. So you're clearly over the 100,000. Can you exclude that person? We don't know. So there's a lot of issues, a lot of unanswered questions, even on this exception. So what's the best way to maximize your forgiveness? To maximize loan forgiveness? It's basically, you need to retain and pay your employees as much as possible during the 8-week period after loan funding. I know you've heard that from me twice, probably already, and you're going to hear it again, and I'm going to say it again. You need to retain and pay your employees as much as possible during the 8-week period. So what's some issues with that? We don't know. Let's say you have a pay period, you have let's say semi-monthly pay periods, and your pay period on the last part of your 8 weeks is paid a day after the end of the 8-week period. Can you include that payroll in it, or do you have to prepay that? We don't know, and we're going to get some guidance on that. We think you should be able to, because it was incurred in the 8-week period. So maximizing payroll is also critical in this case, because the amount of non-payroll costs are keyed to the amount of payroll payroll costs that you are including in your forgiveness amount. So let's go on, and we'll use an example to kind of clarify this. So let's say you have a $500,000 loan, and it's based on, and you got that because you had 2.4 million annual payroll. That divided by 12 times 2.5 months. Remember the 2.5 months? That seems like we went through this calculation years ago, but it was only a few weeks ago, right? April 2nd, when we were applying for our loans. So you got that, and then let's say you keep your same rates, you keep your same employees, and you pay them over the 8-week period. So if you take 2.4, divide by 52 weeks times 8 weeks, you get 369,000. If you divide that amount by 75%, that equals 492,000 that you're eligible. So even if you do everything, you have no reduction, you pay the most, the way that Treasury has put this in, you're going to be short by 8,000. So you're already behind, even if you're doing everything right. And the 492 is why I divide it by 75% is, remember, non-payroll costs can only be up to 25% of the loan forgiveness. So 492 times 25%, it would be the difference between 492 and 369. So let's say that you have no reduction in the headcount, but you're cutting your payroll, your pay rates, and you cut it by 20%. So you're meeting the 75% rule, and you're not going to have any reduction in that. And then you pay them at 80%. The maximum amount of loan forgiveness is 393,000, which is the 295, which is the 80% of the 369, and then the payroll, and you divide that by 75.75, you get to 393. So 98,000 of non-payroll costs. So you can see as your payroll goes down, your non-payroll costs go down too. So that's another reason to maximize your payroll costs. And then you would still owe the bank 107,000, and the interest rate on that's 1%. That's due in 2 years, and then the payments will begin. You have a deferment period of 6 months, and then your payments would begin between months 7 and 13, depending on when you get your forgiveness, when that's calculated. All right. Is there any way to fix this inherent shortfall? Perhaps. Maybe pay a COVID retention bonus. Pay some of the bonuses maybe that you would wait to the end of the year into the 8-week period. But you always have to think you have a limiting factor here, and that is that you're going to have to figure an annualized compensation limit of 100,000 during the 8 weeks. Whether that is going to be calculated, let's say you have a weekly payroll and you pay a COVID bonus on your 8-week period, is that going to be annualized times 52? And if that's the case, then if it's based on a pay period, you're on a weekly pay period, it would be, you could only get $1,923 in that period. But if you base it on an 8-week period, which we think is where it should go, but we don't know, it would be, you could pay up to $15,385 into that 8-week period, and not be up against the 100,000 annualized compensation limit. But it's tricky, and we don't know, and we're going to need guidance, because you're going to need to act really soon on this. Then why should we maximize loan forgiveness? So you may be thinking that you don't care if the loan is forgiven or not, because you're only paying 1% interest, and you need to conserve that money because we might have another downturn. So a couple things to consider. When you certify the loan, to get your loan proceeds, you certified that you were going to spend that on payroll costs, rent, utilities, and mortgage interest. You certified under potential penalties. And Treasury, in their one of their interim final guidance rules, said that you must spend at least 75% of the loan proceeds on payroll costs. They say that when you certified that, you really meant to certify that you were going to spend at least 75% on the loan proceeds. And we think that's an overreach, one of the many, many overreaches, but that they added that. So consider that when you're saying, I'm not going to spend it on payroll, I'm going to just conserve my money and conserve the loan. You might be running afoul of your certification. And the purpose of the loan is really, what is the purpose? It's what does Congress want you to do? They want to keep your employees employed. And we think that is not only a great ethical choice to make, but it also makes financial sense. So you have your business, your workforce ready to go. So, and some more reasons why you should maximize your loan forgiveness. So Congress has said this is for part 1 or part 2 or part 3, but they are counting on the economy recovering after 2.5 months. That's why they figured the PPP loans that way. And we think that, and I think most economists I've heard say basically that this economy is like a building on fire, and Congress and the Fed and the administration has called out the fire department, and at all costs they're going to throw as much water onto this fire, and they're going to keep pouring it on. Now, some of the water is going to go to wrong places and it's not going to hit the mark, but they're just going to keep pouring it on. And the most important thing is not the type of programs, but the fact that Congress and the Fed and the administration is so willing to do whatever it takes to put the fire out. And I think if you're thinking that the money's going to run dry, and if the thing drags on, we're not going to get any more help, just look at what Congress, in a bipartisan way, what's happened in Congress and what the administration and the Fed's willing to do on this. They're going to come back with more. The second area here is the portion of the loan that is forgiven is not only free money. Free money is, it sounds bad, but it is if it's forgiven, but that amount that's forgiven is non-taxable. So why not take advantage of this awesome carrot that's been put in front of you? And then finally, maximizing your forgiveness also maximizes the benefit to your employees. And we believe that, I think if you look at that, they are your most valuable resource. Your employees are going to be there when the economy turns. They're going to be the ones that are going to bring your business back. And we think that this program was an awesome way of throwing, we're talking about different ways of putting the fire out and putting water on it. We think this was a great way of throwing water on the fire, and it's benefiting not only you as an employer, but your employees, and it's good for the entire country and the economy. So that brings us to new developments, guidance, and some major uncertainties. And I've kind of alluded to these things already, but and we're going to talk about that there's at least 10 major areas, and they're very major, need to be clarified in order for us to start accurately calculating loan forgiveness. But before I jump into those, I'm going to ask Mark to kind of go over FAQ 31 and 37. What's the significance? Why are these very serious issues, number one? And what's kind of our opinion on that, Mark and my opinion on those FAQs, and then maybe some practical guidance that we can give the attendees. Okay, Mark, so can you kind of give a rundown on that and get us up to speed?
I'd be happy to. So the FAQ is something that's been going on for a couple of weeks now, and Treasury is adding questions and answers to it on a regular basis. As a matter of fact, we got 37, I believe, came in on Tuesday night, and we've had more added on Wednesday, and as Dave alluded to, we even got another interim final rule this morning. So what is question 31? Well, question 31 is essentially the political response to all of the news media stories about Ruth's Chris Steakhouse and Shake Shack and other public companies being able to get these loans. So yes, these loans are for small businesses, but Congress deliberately went out of their way in at least 2 or 3 provisions to include the entire food service industry and to include all franchisees. So that applies to auto dealers and other big franchise sellers. That was deliberate. I mean, it had to be. I mean, they added provisions to the law to make that happen. Well, the news media took this on as, isn't this horrible that these big companies are getting the money? And they could have easily have written the story the other way around that said, hey, isn't this wonderful that Congress thought enough about our food service workers that they wanted to be absolutely certain they got paid even if they weren't working. And so we all saw the press, we know what happened, and Treasury came out with Fact 31, which basically said that even though you otherwise qualify for this loan, we're going to add a new provision that says if you're a public company and you have access to capital markets or other sources of liquidity, we don't think you should get the loan. This is not in the act. It's not what Congress intended. It is an invention of Treasury, and we think it's a big overreach. Just like the 75% was not included in the act, but that one makes a little more sense because the purpose of the act is to get people paid. So that, and all they're doing was reducing the carrot a little bit, but they weren't changing the primary purpose. So what did they do on Tuesday night? On Tuesday night, they released Fact 37, which essentially says, hey, that thing we did with publicly traded companies? We think that's such a great idea. We're going to apply it to everybody. And the way they're interpreting this they're essentially crossing out the waiver of the no credit elsewhere provisions. The reason many of you have never dealt with SBA before is because you can only go to SBA when you can't go anywhere else. Yeah, and that's what the access to credit elsewhere idea is all about. And so it's even more frustrating because if we look at the actual wording of question 31, it says that all borrowers should carefully review the required certification that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Well, what does that mean? A common sense reading of that says that, well, certainly you as a business owner are going to behave differently if the government is enticing you to pay people versus you need to borrow money just to keep your staff ready for the recovery. There's a big difference between raiding your piggy bank or going further into debt than there is accepting essentially a grant from the federal government. Well, Treasury's not looking at it that way, and at all. I'm sorry. And so they say that borrowers must make this certification in good faith, taking into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. Well, wait a minute. Many of you have already laid people off before you got your loan, and the real issue is, what am I going to do now that I have the loan? So clearly you already made the assessment that it was detrimental to your business to keep people on. Or maybe you're worried that you're going to have to make that decision, a month from now, when we still don't know when the recovery starts. So, we're very frustrated here because this seems like this is Treasury just flat overruling Congress's intent on who should get the money, how the money should be used, and it, if this were a tax law, we would be very comfortable saying, hey, Treasury's got this one so wrong, we're okay with filing the return, based on the code, not based on Treasury's interpretation. And we can discuss the risks, the potential penalties, all of that. We're good at that. We're tax people. But in this case, Treasury, well, one more piece here is that just last night, they said they're literally going to audit every loan greater than $2 million. And what are they going to audit? They're going to audit this certification. That's what they're really after. And the banks can audit all of the calculations and documentation for the loan and the forgiveness. But this is what they're going to review. And unfortunately, this certification, if they claim that you didn't make it in good faith, which clearly everybody read it and agreed with it and did make it in good faith, if they say you didn't, and they may say you didn't merely because you're healthy or your balance sheet looks good, then that potentially could lead to a charge of fraud. Well, now we're talking criminal matters, And that's got nothing to do with tax law. That's not an area that we are at all comfortable with. And so it seems to us that the larger your loan, particularly if it's over 2 million, means that you really should be consulting an attorney about this now. And since the deadline to return the money is May 7th, it's kind of urgent, to put it mildly. And our opinion is that it's an overreach, but we're not criminal lawyers. We're not SBA lawyers. Our experience with SBA is fairly limited because most of our clients do get credit from other sources and are sufficiently sound that they get credit from other sources.
All right.
Okay.
Yeah, I think that's fair. So we're not in agreement, as you can tell, but you should consider consulting an attorney if you feel like there's any way that they could challenge that your certification, whether that was made in good faith or not, and especially if your loan was over 2 million, because you will be audited. And what Mark said by audited means the SBA is going to be looking primarily at your certifications and whether they think that you were in good faith. So it's a huge, huge thing. Sorry, I don't write the laws. Treasury is making up rules as we go. And the unfortunate thing, like Mark said, we can fight this in tax court and so forth, but how long, this is you have to make decisions now on the fly, and you can't worry about having to fight a criminal case in court for several months. It's not going to happen. So it's just a horrendous abuse, I believe. But anyway,
I agree. Yeah. I agree with Dave. I just want to add that we have been advising clients, particularly those clients that laid off employees, got big loans, and are bringing them back. That's precisely what what Congress wanted to have happen. And so we have been, when there was only question 31 out there, we said, okay, that's a political response, and well, we disagree with it, that it wasn't so bad. And we've been advising clients, many of you, that there's no problem making the certification. But now, given last night's question 37, we apologize but we're not clairvoyant. This is literally changing day by day, and that's clearly unfair.
Okay, so moving on, we'll try to breeze through these, but these are the major areas of uncertainties now. There's at least 10. We're going to talk about some of the major ones. But so the first is, and this is getting into an area that Mark and I are comfortable playing around in, is taxability. And this is, what does non-taxable really mean? And there's been talk, and that Treasury will come out and say that the loan proceeds that are forgiven are non-taxable, but we're going to apply Section 265. What's Section 265? Basically it says that expenses that are incurred for the production of tax-exempt income are non-deductible. So let's say you have a $500,000 loan forgiveness, and then you have corresponding $500,000 of payroll cost on your P&L. So the way that we think the act works is you're going to have zero income, and then you're still going to be able to deduct your $500,000. Section 265, if that's applied, would say $500,000 of income, $500,000 of non-deductible expenses, net effect is zero. What's the difference between that and just showing the loan forgiveness as income, taxable income? There is no difference. So by applying Section 265, it would basically have the effect of negating the carrot that Congress is putting out in front of you. We don't think it will go, but we'll have to see what Treasury does. The next, cost incurred and payments made. So we've talked about this quite a bit as we went along, but in payroll, it kind of is when are you incurring your payroll? If you don't pay it by the end of the 8 weeks, can you still deduct it because you've incurred it? If you have a week and a 2-week period, payroll period in the 8 weeks, can you deduct that? But you haven't paid it. We don't know we're going to have to wait and see what's going to happen on that. It's an accrual versus a cash basis, and another way for accountants can look at it. There's 3 ways. It could be cost incurred and payments made, which would, both of those, you can throw everything in. You can load in profit sharing plan contributions for the year. As long as you pay it, you can include that in payroll costs. But if it's incurred, it has to be incurred and paid. That would prevent stuffing, and it would limit how much you can put into the period. So we don't know what's the combination and how that's going to work, but that's going to be an important factor. Another one is 8 weeks periods that extend beyond June 30th. Some of you are not going to be getting your loan proceeds so when the clock ends on 8 weeks, it's going to extend into July. Can you include those costs that go beyond June 30th? The way it reads now, no, you wouldn't, but we'll see how that's going to play out. So another is self-employed independent contractor loans. We got some guidance on that. I'm just going to address the Schedule C sole proprietor that has no employees, and the question is, how did you get your loan proceeds? You got it based on 2.5 months, or 2.5 divided by 12 of your 2019 Schedule C. Your loan forgiveness is, the way it's been put out right now, is just going to be 8 divided by 52 times the same 2019 Schedule C income. Do you get to add rent and utilities and mortgage interest to that, just like everybody else? And it seems like Treasury saying no. And their justification for that is that people that file Schedule Cs usually are working out of their garage or working out of their home, and they don't have the overhead costs. So they're not going to include that. But we're still waiting for guidance. Self-rental payments included. What's a self-rental payment? You own a manufacturing business, but you also own the real estate that the manufacturing business is operating on. You lease it to the business. Can those rent payments be included? We think so. We don't know for sure. And then the next 3 could take up the entire hour, but difficulties with the headcount calculation, who counts towards the rehire exemption, and difficulties with the salary reduction calculations. We kind of covered some of that already, I think, but Mark, can you summarize just a few points here, and then we can wrap this up? Okay.
Well, let's start with the headcount calculation. That applies all over the place. I mean, it's very nice of the Treasury to tell us now, after everybody's applied, that headcount on the face of the application now includes literally everybody. It's not an FTE calculation. It's literally a headcount, even if somebody only worked an hour for you. So that's kind of surprising. It probably doesn't make a difference for many people, but if somebody was right on the border, it could. The real difficulties with the headcount calculations are when we're using FTEs. And I think if you recall back to the description of how that is going to work, you literally have 4 different periods, or even 5 different periods, that you have to look at the headcount, and we literally don't know what method we're supposed to use, whether it's 30 hours or 40 hours, or how we're going to do that. When does somebody count as a full-time employee? Why is that important? If somebody was literally a 40-hour employee during during a look-back period, but now during the 8-week period, you guys are only working 30, does everybody count as full-time, or does nobody count as full-time? It's frustrating. The difficulties with the salary reduction, some commentators are saying the way it's written is we're comparing the first quarter of 2020 to an 8-week period after loan funding, and virtually excuse me, virtually everybody is going to fail the 75% test. I don't think that's what was intended. I think it's all based on pay rates, but still there are questions there. And then this rehire exemption, well, if you are being hit by a limitation for either headcount or salary, pay rates, then you at least have the out on the rehire exemption. But it's unclear whether that two-part test apply. If an employee meets that two-part test, are they excluded from both the headcount reduction and the salary reduction, or the pay rate reduction test? We don't know. We also don't know if the headcount rate is a cliff test, meaning that it's all or nothing. I mean, if you restored some people but not others, do you get the benefit of that partial restoration? We don't know. We also don't know how Treasury is going to interpret the fact that the rehire is based on the employees that you had between February 15th and April 27th. Well, that's got nothing to do with any of the calculations for the head count limitation. So it's just a real mess, and we were owed these explanations a while ago, and who knows when we're actually going to get them.
When that happens, we'll be here. But so this is I know it's depressing, but it's also encouraging. I mean, we know what the most important things we need to be doing, but I just want to read this quote to sum it up. This is from Tony Nitti, who's Mark and one of her favorite writers. He's Forbes, and here's the quote: If you stuck with me this long, and you could say with Mark and me this long, and you probably have not, you appreciate the severity of the situation. We don't know what costs are forgiven. We don't know what will determine which costs are allowed. Is it incurred, paid, or both? We don't understand the time frames. We don't know if we can deduct the expenses paid with forgiven dollars. We have no idea how to compute the reduction in forgiveness related to lost employees or reduced salaries, or how to restore that reduction if it occurs. And lastly, none of it may matter because the banks are going to make the rules, and they don't know what the hell they're doing. Other than that, we've got this all figured out. And I think, that basically sums it all up. But I want to kind of take the focus away, because I think a lot of people are focusing on all the details. Well, there's not answers for all the details, but take a step back. The big picture is what this whole presentation is about. You need to hire your employees back. You need to pay them full payroll during this 8-week period at least, and do it soon, do it now. And it's going to be beneficial to you, your company, your employees, and it would be for when this thing turns, and it's going to turn, and we feel there's going to be so much pent up demand. There's so much liquidity out there right now that you'll be ready with your company to face the new economy. So I think that's it, and we have time for some Q&A, and I think we'll address the ones that were sent in originally, but I think we have probably over 50, 60 questions on our list right now. So let me hit the questions that we got in advance first, and then you guys, however long you want to stick around, we'll be answering as many questions as we can. We're not going to cut the webinar off, and hopefully we'll hit your question. And if we don't, then some of these we can't answer, as you can tell. We just don't know what direction Treasury and the SBA is going to go with it, but we'll do our best here to answer as many. So the first question we got in was that it kind of had a couple parts to it, but they have been this company has been trying to get financing, the PPP loan, and they've been running into difficulties with one lender, and then they've applied with another lender, and in the meantime they've brought all their employees back, and they're paying all their employees, and the question basically is, can we go back and count the amounts that we've been paying our employees, because we're doing this in anticipation of getting the loan? And unfortunately, the answer is no. The way the rules are written, the 8-week period for measurement for forgiveness starts with the date of funding. So unfortunately, you can't go back and pull into the period, the 8-week period, what you've already been paying. And the second thing I want to just caution this person that asked is, if you have two apps in with the SBA right now, and they both go at the same time, you're going to get turned down because you can only have one application submitted. So you better make sure that you pull one of those applications before they're submitted. So the next question is, from an employee viewpoint and a part-time basis, is it for their employer, is it wise to bring back part-time people? And I guess the answer I would say is bring back as many people as you can, because again, maximizing your payroll costs is going to maximize your loan forgiveness. So that was that question. Another question has to do with and the next two questions are both fairly similar. We want to pay our employees bonuses for returning and coming back, or we want to pay them an incentive, a COVID-19 incentive to return. And let's say we're going to hire them back, but we're going to pay them their bonus in week 8 and of the forgiveness period. And again, that has to do with this annualization issue. If Treasury takes a position that you have to annualize it based on a weekly period, and if you pay it all in week 8, do you get limited to $1,923 of compensation? Or can you use the $15,385 computation for the 8-week period? We don't know. And again, going back to our advice, hire your employees back as soon as possible and pay them ratably as much as possible during the whole period, because you could be up against this crazy interpretation for annualization. Same thing about prepaying utilities. I think we're going to have some kind of anti-stuffing rules, you know, going and paying your utilities for 3 months out. Again, it goes back to the whole concept of paid and incurred. What is going to be the interpretation of that? We don't know. I would imagine it's going to be something like you can pay something, and as long as you incur it within 30 days of when you pay it, maybe something like that, but we don't know. Another one is a question on the 1% interest on the loan. When does the 1% interest start? It starts the date you fund. It starts accruing. And then the next question is, let's say that 90% of your loan gets forgiven, and what happens to the 1%? Well, the statute says that only the principal portion is forgiven, but Treasury has indicated or ruled that 1%, that the 1% interest related to the forgiveness amount will be forgiven also. But we're not sure if that, you know, what the final is on that, but that's what the indication is. Next question has to do with the shareholder distributions. I'm presuming this is an S corporation. And the question is whether you can include shareholder distribution as a payroll cost. The answer is no. It's not a payroll cost. And then the thought is, well, can we start paying the shareholders that are employees big bonuses to cover the gap during the 8-week period? And if there is a suggested threshold that we should not go over if we give a raise or bonus. And I think I've talked about this several times. It's either, depending on what the annualization calculation is, if it's a weekly basis, it's $1,923 per week. So if you pay it all in 1 week, that would be your limit. And it would be $15,385 if you look at it over the entire 8-week period. So if you're already paying your shareholder employees over $100,000, stuffing bonuses in is not going to, will give you zero benefit. So sorry about that. Next question is contract labor. And unfortunately, contract labor was specifically excluded. This is, you're paying 1099s to independent contractors, and that's not a payroll cost. That's been specifically excluded. And then it goes on to say, what happens? Well, if that person is not applying for a PPP loan themselves, can we use their benefit? And the answer is no. It's not your payroll cost. Is worker compensation insurance included? The answer is no. It's not an included payroll cost. Health insurance is, but workers' compensation is not. How will the forgiveness process work? And what is the best? So I think we've answered that question. we have to wait and see what is the best way for us to, as employers, I think, to apply for the process. So your bank is going to be driving all the application process. They're going to be giving you exactly the documentation necessary. We do know right now that payroll tax returns will be one of the documents that you will need to provide. What is that? What's the importance of that? Your payroll period that includes the 8 weeks will include your second quarter payroll tax return, which is June 30th. If you're going to have to provide that to get forgiveness, that's probably not going to be prepared until the middle of July. So you're, in terms of getting loan forgiveness and applying, that's going to be the earliest, and you're going to apply, and then your lender has 60 days to go through your documents and then grant forgiveness. So we could be in the fall when your forgiveness is going to be granted, okay? And then what are some employee benefits that we should be looking at that would qualify? So we mentioned health insurance, but retirement benefits are, it's payments of retirement benefits. Does that mean you can make your 2020 profit sharing contribution in 8 weeks and make it count? And it's something that is one of the few benefits that maybe we could do something with on this. So I think stay tuned. That will be part, when we get updates and we do our next presentation, that will be one of the key things to look at. That would be, I don't know, Mark, is there any other employee benefits that I'm missing here?
Well, one thing that you might consider doing is, at least for the 8-week period, maybe you pay your employees' share of the healthcare costs as well. You know, I mean,
yeah,
that's one possible. We don't know for sure, but that's one possibility. But essentially, the only benefits are retirement benefits and healthcare costs. I had something I wanted to add to the first part of this question, and I'm not familiar with Aerotech, and so I don't know if that is essentially a temporary agency or a contract agency, or if it's something more akin to an SEO or a PEO. And the reason that matters is that if you have an SEO, those employees are considered your employees for purposes of this program. Well, they aren't your employees for other purposes. But that's kind of the extreme, and if it's just closer to a temp agency, then no, then you don't, they're not your employees. And you know, we've had an unfortunate situation where one client entered into a management agreement with another company, and that agreement spelled out that the employees weren't theirs. It's like, sorry, you know, that's what you agreed to. So, yeah, you know, there is a little wiggle room there, but short of an SEO or a PEO, I don't think you can claim them.
Great. Okay, so those were the pre-submitted questions, and then I think, Jill, you've been putting some in here and from the question box. So I'm just going to go down these one at a time. Does paying mean the last day of the pay period, or only the date on the check's direct deposit? So that is, we're not sure, again, on the paid and incurred, if paying is going to even matter on payroll. If we get guidance that says that, you know, if 5 days of this pay period flop into the 8-week period, you can include that in there, or if you have to pay it. I would think paying means when you cut the checks to your employees. If Treasury is going to say, no, you got to pay it, we're going to do the worst possible interpretation of incurred and paid, which would be, you have to not only incur it, you have to pay it. And if you don't pay it, even though you've incurred it, you can't include it. And I think Treasury might do that, seeing everything else they're doing. That means, to me, that means you have to cut the checks or direct deposit into your employees' accounts, or however you do payroll, to have that included. But again, we don't know what the standard is on that. Can we pay employees more than their usual pay? And the answer is yes. And this is another possibility, is, you know, you might have some employees that are saying, I don't want to come back because I'm getting my $600 a week plus $400 state unemployment. And you might say, okay, I'll pay you $1,100. I'll pay you $100 more than what you're making. And it's more than what they normally have paid. It's fine to do. Remember though, we have this 100,000 annualization concept that you have to always keep in mind. You know, you can't just pour in tons of money and make it work, because you're going to have to annualize that out. Are eligible expenses costs during the 8-week period for actual expenses during the 8-week period, or can they be paid after the 8-week period for payments incurred? That's exactly what we've been talking about. That's the paid and incurred. And again, we're not sure how that's going to work. The best interpretation, or the right interpretation, in my opinion, is that if they're incurred during the 8-week period, even though you pay them after the end of the 8-week period, you should be able to include those. I mean, it just makes sense. It would just be totally punitive that you're abiding by it, and your payroll period happens to flop your pay period, you know, after the end of the 8-week period. It would be very punitive. But again, I have a sneaking suspicion that we're going to get some punitive type rules when they come out, whenever they do, sometime. What is the payback period for the FTE look back calculation? Do you understand that, Mark? Or
I do not understand the question.
okay. So I guess the payback period, maybe you're talking about if you don't get forgiveness, you know, you have a reduction in your forgiveness amount, and then when the loan's paid back, it's deferred for 6 months, and then it's paid back over 2 years. If we expend the money within the 8-week period, can we prepay future months' rents, staying within the 25%? It's a great thought. And again, we're back to our paid and incurred question. And if you're paying it, and if we go with a paid and incurred, these, you know, what we think Treasury is going to do, the strict area, you're not incurring those expenses, right? You're paying, but you're not incurring them. So that would mean that you couldn't put those into your calculation. But we don't know on that. And you know, if we get a more liberal, the more liberal would be, you can include costs that are paid and costs that are incurred, both. You know, it's not restrictive. Okay. Let's see, any bonuses included in the loan forgiveness for payroll? Yeah, any bonuses that you pay during the 8-week period will be included, as long as you don't go beyond the 100,000 annualization calculation. What if you have an employee that wants to be off to take care of kids, and we offered them to work from home, but we need someone to fill that role so we can operate daily? Do I still need to pay them if I have to replace them to keep operating? So that question hit on all the uncertainties that when Mark brought up about replacing your employees, and how that works in the headcount calculation and how that works in the pay rate calculation. Whether somebody's furloughed, Jane Smith is furloughed, and John Jones is a replacement, whether John Jones can count in the head count and the pay rate count against Jane Smith, or can you do that? We don't know. Do I still need to pay them if I have to replace them to keep operating? I would say if they're not employed, or they're staying on unemployment or whatever, I would say no, you don't have to. You can replace them, but then you're starting to talk about some labor law issues. So a person on maternity leave, or that's on furlough, or does not want to come back because they're afraid of the virus, and then you replace them so you can maximize loan forgiveness. What happens when after the 39 weeks ends and their unemployment, you know, they come back and they say, I want my position back? What are you going to do? And I'm sure there's already attorneys out there that are developing, you know, farming cases where, you know, unlawful termination, and this is, you know, labor law. I'm wading in waters that that I shouldn't go into, but again, some of these decisions you might need to talk to an attorney and protect yourself, because it could be a sticky wicket. There have been rumors that some banks are reducing credit lines. Okay, so this goes to my original thought of, okay, money's fungible, pay down your credit line, and then if you do, then you can just draw on it when you have the expenses. And there is the risk. What happens if the bank says, oh, we're going to cut your credit line. You're not on it now. We're going to cut it down. I would say that's a risk. You have to consider that risk. I have no real answer for that. And if you want to not have any of that risk, then keep the money in your account and keep it as a reserve, and don't take advantage of that. To me, banks aren't in this financial crisis. They're not hurting. They have plenty of liquidity. The Fed's making sure that everything's, they're doing fine. This recession, or maybe even semi-depression, is totally different from the Great Recession, where the banks and financial institutions took us into the recession. This is a consumer-driven recession, and the banks maybe eventually will start having some issues, but I think the Fed, to have a bank pull your credit line would, I don't know, they could do that, but change banks. We received our PPP loan on April 20th. Okay, congratulations, very good. Our payback expires June 20th, and it might, our payback means your loan forgiveness period ends June 20th. It's probably June 19th. So be careful on that when you count the 8 weeks, right, Mark? So we plan on bringing back half of our 6 employees full-time May 1st, and then the remainder 3 back full-time June 1st. We will use over 80% of our loan for payroll. So I guess all staff will be paid greater than 75%. Will this satisfy full forgiveness? So remember, you're conflating 2 tests, or 2 issues. One is the headcount and pay rate reductions. And if you bring them all back and you're paying them greater than 75%, and you do this by June 30th, which you will, because you're going to bring them back by June, I think you said June 1st, you're going to be fine with that. But in the meantime, you know, I would kind of think, how are you going to get to 80% of your loan, of the amount of your loan? Remember, your loan was calculated on 2.5 months worth of payroll, and then you're not bringing employees back till June 1st or May 1st, and then the rest by June 1st. And the loan forgiveness period is 8 weeks. And so I would just kind of caution you to say, how are you going to get to 80% of loan, you know, full forgiveness by doing that? So go back, review the examples I gave, and rerun your calculations, because I think and then if you try to stuff a bunch of payroll into the last week or the last couple weeks, then you might be running afoul of the 100,000 annualization limit. I thought I read as one of the rules that you cannot give bonuses. I'm not aware of that rule, but I think you can give bonuses, but I think you need to be aware of the 100,000 annualization limit. So maybe that's where you're reading that. Can we fund our 401k safe harbor during the 8 weeks and have that forgiven? And that is one that we mentioned before. We think it's a very viable thing to think about and to make to push your profit sharing contributions into that period. But we don't know how the Treasury is going to make the paid and incurred thing, because let's say you make it for the entire 2020 pay period. You make the safe harbor and or a profit sharing contribution. So that was paid and it's an employee benefit that qualifies, but was it incurred? Would you have to take that amount and divide it by 52 and multiply by 8 for what's going to be included? My advice is we don't know, but there's a chance that you can do it. And if you have the money from the loan, and I think it's a great policy, let's start thinking about funding profit sharing contributions, safe harbor contributions, anything you can during the 8 week period. And then the worst thing that could happen is it'll be totally excluded, but I don't think that's the case. The worst thing probably would be 8/52 of that amount can be used. Another issue would be, let's say you have accrued a profit sharing contribution for 2019 and your tax return's on extension, and it is because it's July 15th deadline, right? So you are going to make your 2019 profit sharing contribution. I would say make that during the 8 weeks also, because if we get a liberal interpretation of paid and incurred, where it's paid, that would be a retirement cost included in the 8 weeks. If it's paid and incurred strict interpretation, that would be a contribution for 2019. Of course, it wasn't incurred in the 8 week period. So again, I would say there's not much to lose from a cash flow perspective if you have the loan proceeds to do all these types of retirement plan funding in the 8 weeks, and then we'll have to sort out what happens. Okay, can we give a bonus to only part of our employees, i.e. those that are for sure? I mean, if you want to maximize and pay bonuses, calculate how much it would be, and to maximize how much you could get on forgiveness, I would say go for it. Remember the 100,000 annualization limit. Can the employer portion of payroll taxes and workers' comp be included towards the 75% payroll? So the employer, so Mark, help me on this, on the employer portion of payroll taxes is included for California payroll taxes or state payroll taxes, but not federal payroll taxes, I believe, right?
That's exactly right. Only the employer portion of state taxes. And we're not talking about withholding, we're only talking about the actual, employer payroll taxes.
Right. But as we said before, workers' comp cannot be included, sorry. You mentioned the loan forgiveness amount is non-taxable, but isn't it all non-taxable as it is a loan, which will, yeah, so that's gonna, just to clarify. So let's say you have a 500,000 loan, you get 400,000 forgiven. None of that is going to be taxable. The 400,000 is, but on your profit and loss statement, you're going to have $400,000 of income. It's just not going to be taxable. The 100,000 that's left is going to be on your balance sheet as a debt still. So none of it will go and be taxable. We haven't received PPP. We filed on April 6th with Chase and didn't make the first round, still waiting on the second round. I'm sorry. This is a very common situation, and there's a bunch of people in the same boat. If you receive the PPP money, do rules that come after you receive the money still apply to you? So I think what you're saying maybe is these FAQ 31, 37, some of these things where you certified and then you get the money and maybe you don't get the money till May 8th. And you have to pay that back by May 7th. What do you if you feel like you're nervous about the FAQ 31 and 37? I don't know. I think maybe it would be if you haven't got your money yet, but you decided I want to pay it back. And we're not advising you to do that. We're not saying that. We just think you need to be aware of all the risks involved in these FAQs. But I would think if you don't get your money until after May 7th and you want to pay it back, then pay it back as soon as you get it, I suppose. Don't know.
Or don't sign the loan documents. Or
you can, or right now you could call up Chase and say, I don't want the loan, pull my app. And I think that's always possible. Yeah.
What's so frustrating about this is early on, Treasury and SBA clearly said that banks and borrowers could rely on the rules as they were promulgated when you made your application. But since then, they've been issuing these interim final rules and facts that clearly change things, and they're acting as if they apply to everybody. So the idea that we should have been able to rely on what we knew at the time of application is a valid one, but I don't know how that's going to play out. That's why we're advising that if you have a large loan, you do need to talk to somebody who deals with this.
What is your opinion on laying employees off after the 8-week period? My opinion. It's just my opinion, but if you listen to what I was saying in the presentation, I would say keep your employees going. I think when the economy turns, that's a financial decision that only you can make. I would encourage you not to. And if the 8-week period is you're still struggling, I think we're going to get another PPP loan tranche coming out. So watch for that. But I can't make those decisions for you. I can only encourage you to look at the bigger picture and the benefit to your employees and to your company. And I think in the big picture, I think things will start turning, but that's your choice. So, hi, still unclear on the annual $100,000 limit for payroll. Okay, good question. If an owner gets more than that, can he still get his regular pay, or will it be maxed at $100,000? His pay was accounted into the loan. So when you accounted for it in the loan, you maxed it at $100,000. And it's going to be the same way during the 8-week period. It's just we don't know how the $100,000 is going to be annualized for the 8-week period. But in general, if they're getting regular pay during that period and they're well over 100,000, it's just going to be, what is it, 100,000 divided by, it's going to be, the maximum amount for somebody in that situation is 15,385.
That's the maximum forgiveness. The maximum loan
Yeah.
is 20,833.
Yep. Okay. I'm a sole proprietor and I work as an independent contractor in another place. Can I apply this money as an independent contractor? I think you can only have, I think what you're maybe saying is that you have two business activities. I think your sole proprietor that has certain work, but then you also get a 1099 in another trade or business. I think it's a per independent contractor. I am not 100% sure per person, so I don't think it would be possible to do that. I don't know. Do you have any clue on that, Mark?
I believe it is. If you're applying as an individual, you can only get one PPP loan,
Yeah.
just like a business can only get a single PPP loan. So if you're a sole proprietor, if your Schedule C has income in excess of 100,000, net income in excess of 100,000, then it doesn't matter what your second activity's income is. If your Schedule C is less, then presumably you'll want to apply for whichever one's greater. And I do not know whether there's any provision to add the two together.
Yeah, I'm not aware of that either. I think it's one. We are trying to reach the 75% payroll of the on the loan forgiveness. What if we don't reach it? Could we return the difference? So there's two things here, I think. One is the forgiveness calculation, and I showed you that even if you keep the same payroll and everything going, you're going to get to 74.8%. No one, by the math, the way the math works, the way they set this up, is ever going to reach full forgiveness. So, and for that amount that you can't reach, you will have to pay it back, and it's in over 2 years, starting 6 months out. I
think there may be some confusion between when you have to pay it. I mean, there in the very first interim final rule, not only did Treasury add this 75% feature for forgiveness, but they also put an absolute requirement that 75% of the proceeds be used for payroll costs. But they haven't given us any guidance as to when that has to happen. Let's say you only kept your top 20% of your employees. Could you use this loan to pay them until it ran out? Sure. Your forgiveness would be limited because you didn't pay very much in the 8 weeks, but that would be permissible. And so there are some banks that are saying whatever is not forgiven, you have to give back to us right now. And that's just not supported by what Treasury's saying or by what the Act says. And so, yes, you want to spend as much of it as you can in the 8 weeks, but what's left over, you can continue to spend in the same 75-25 ratio of payroll and non-payroll. So,
yep. It's just not going to be, that's the conflating, the forgiveness calculation and what you're spending it on certification. And you certified on your application that you were going to spend it on payroll cost, rent, utilities, mortgage interest. That's just meaning how you're spending it. It's not the 8-week forgiveness. And then Treasury came in and said, when you certified, you really meant to say that you were certifying 75% of it's going to go to payroll costs, which that's not on my loan app, you know, that wasn't there. And, but like Mark said, if you eventually spend it over 2 months or 12 weeks on up to 75% of payroll costs, you've met your certification. It's not going to qualify for loan forgiveness though. So, and then we'll be paying that back because it wasn't forgiven. I am a sole proprietor and I work as an independent contractor. I think I have that already.
Yep.
What if our state or county or city still has this in effect, the stay home order for non-essentials beyond the 8-week period? A lot of what ifs right now. Things are changing. I just heard this morning that we're expecting a second wave to come through. I don't know. I guess the question is, what are we going to do? What is Congress and the administration going to do if this keeps dragging on? Maybe that's the question. And I think going back to putting the fire out, and Congress and Treasury and the administration, our firemen, they're going to keep pouring the water on it. So what if? Expect more of the same. Maybe we won't get as liberal. They'll say, okay, only half of this gets forgiven or something like that. But right now we have, I think, the best offer on the table, and that's forgiveness for any part of the loan that we can pay out in payroll costs during the 8-week period. Define what the type of good question. What the type of company they are identifying in FAQ 37. And let me look at FAQ 37. I have it right here. I can tell you. So this is the language of FAQ 37. Do businesses owned by private companies? Does it have to be owned by? Does that mean individuals, or can we make a differentiation between businesses owned by private companies and businesses owned by individuals? But I think it's just a sloppy writing. What they're trying to say is private companies, look, they answered, do businesses owned by private companies with adequate sources of liquidity? Again, we have this credit elsewhere type of thing that they're ignoring. To support the business's ongoing operations qualify for a PPP loan. And the answer is C, response to FAQ 31. I mean, the question is worded poorly, and it just says, we're going to say private companies are, I think that's their intention, private companies are on the same footing as public companies. It's written as owned by private companies. So it's almost like maybe that means private equity firms. Maybe you can say it's not talking about companies owned by individuals. But I don't know, Mark, your opinion on that? Is it just poorly written, or could it mean something else?
Yeah. Yes. I mean, we can look at this and say, oh, they really are just going after private equity. But I think that in combination with question 39 that says we're going to look at everything over $2 million, I'm worried that there are people at Treasury who don't like this program, think Congress made a mistake in the first place, and are trying to eliminate all the big dollar loans. So
it's a good question. It kind of, you can tell by our response when something's poorly worded, it creates more ambiguities, and I think that's where we are. But I interpreted it as they're comparing the public sector, publicly owned companies with private companies, and it doesn't mean private equity owned companies. It just means private versus public. I think that's the emphasis, but we'll have to wait and see.
And even if it is the other, even if it does mean private equity, I agree with you. I think it means all private companies. But even if it did, there's nothing stopping Treasury from issuing question 40 tomorrow or today.
Right. Okay. Any interest on other kind of loans, not mortgage, is that forgivable? For example, a loan for building your facility, but it's not a mortgage. That's a good question. The whole thing about interest, I think, was one of the 10 major points that we didn't include. I think the statute is that it's unclear, and the amount that to get your loan, the statute said you can include interest on anything to include on the amount, but only mortgage interest is included in the forgiveness calculation. How far can you stretch that? I think, Mark, we talked about this. What's your thoughts on what kind of interest?
Let's put lines of credit on one end of the spectrum and a fully amortizing mortgage on the other end. Where does a amortizing car loan go? Where does an inventory financing loan go? Well, I think the car loan goes closer to the building mortgage, and I think the inventory financing goes closer to the line of credit. And the line of credit is going to fail both as a permissible use of the funds and as a forgivable use of the funds, where the car loan, the amortizing mortgage, a mortgage that, something that is secured by real or personal property and has payments that go that pay off over its term, those I think are forgivable. I don't think it has to be just a building mortgage as we think. If you're talking about a construction loan or something else, that's somewhere in the middle, and I hate to say it, but we just don't know.
A good question, and we'll include, when we get guidance, we'll update you on that. The next one I have, is there a prepayment penalty? So you say you think you have better use of your money than paying the 1% loan, and you want to prepay it. There is no prepayment penalties. No. I would just say consider the 1% loan financing and when you make your decision. And I don't see any on the submitted questions, but I'm seeing some on our Q&A side. There's some on our chat. Let me see. Go ahead, Mark.
If we go to if we want to go to the chat and finish off that box, and then move over to the Q&A, many of these we have already answered. There is a question that's asking, what if employees resigned in the first quarter? Well, then they would be included in part of the, for the pay periods that they were there, they'd be included in the head count, and then they wouldn't be later. Presumably, you'll be able to replace that employee before June 30th, but we're hoping to get guidance on that. And then we're being told that somebody successfully had two loan applications in, and they signed the first one, and the second one was rejected, and that worked for them. I say congratulations.
Congratulations.
You got lucky, I think, because we know of at least one case where they both got tossed. So, well, and we've been told by bankers that that's what would happen. So, congratulations. I don't know that I want to run that risk for anybody who's still trying to get loan funds. Somebody's asking for confirmation of using a SEO or a PEO, and it is yes, you do include those employees as in your payroll costs. You need to get the reason that works is that when the SEO or PEO files their payroll tax returns, they break out your company by itself so they can give you the data on only your people, and you can then use it for your loan. And somebody else is asking for more clarification on what 265 means, or what Section 265 does. And effectively what 265 does is that it means that your expenses are not deductible. So if you had Dave's example, you had 500,000 of payroll costs and 500,000 were forgiven and were not taxable, 265 would come in and you'd have to make an adjustment to your payroll cost expenses and not deduct them. So it essentially, as we said, if Treasury applies 265 to these loans, it just takes that benefit away. So we don't think Congress intended that by any means. And then we have have you found where I am in the scroll, Dave?
Well, are you on the chat? You're on the chat side?
I'm on the chat at 11:13.
Yeah.
And so there's another question on the 100,000 limit. If an owner gets more than that, can he still get his regular pay, or will it be maxed at 100? All cash compensation is maxed at 100. The healthcare benefits are can be in excess of that, and the retirement plan contributions can be in excess of that. Okay, let's see, that was answered.
I think we got most of everything in the chat box. There were
The chat box is done. Excuse me, Dave. A lot of similar questions in the Q&A. One of them here, will LSL be able to help us with these forgiveness calculations? Absolutely.
Yes. And as you could probably tell, we could, right now, we just need more guidance. I think hopefully this has been helpful to you to give you more of a big picture, the most important things that you can be doing right now. But when we get more guidance, what we'll try to do is we're gonna try to be able to help you make the calculations. What documentation that you need, your bank is going to be driving that whole ship. So I think in gathering that, whatever the bank requires, we can help you with. Making calculations, we can help you with. Yeah, just contact us. I think, Jill, we'll try to schedule as soon as we get some solid guidance. And just remember on the loan amount, which was, in my opinion, a lot simpler calculation and issues. They were 5 days late with getting the rules out, and they updated it. They did a final at least 3 times after that. Okay, so we're we're just as antsy as you are. We'll stay on top of it, and then we'll try to get something like this out and guide you. And I think at that point, you need to, to call us, and then we can guide you through it, help you with all the calculations, and yeah, so we're here for you.
I've found one more that I want to cover in the chat box.
Okay.
And that is asking about the look back on when we're comparing the FTEs during the 8-week period and the look back period. The question is essentially, what is the look back period? It's not the 12 months that you used to calculate your to calculate your loan amount. It's one of two periods. It's either February 15th through June 30th of 2019, or it's January 1st through February 29th of 2020. You can use whichever one of those numbers is lower, because that will be to your benefit. But remember that those employees that made over 100,000 in any, or were paid 100,000 annual rate in any period during 2019 get excluded from this calculation. So yes, that's why there's the confusion about, is it the 12-month period? Well, it is for one part, but not for the general calculation. I hope that helps.
So I'm over in the Q&A. A lot of good questions. There's one about, people now are on deferred payments on their mortgages because of the crisis. And so your interest is accruing, but you're not going to pay it till after the 8-week period. Well, that deferred interest, can you include that as mortgage interest in your calculation? And again, we don't know what incurred and paid interpretation. You can see that's going to be a real important one. My feeling is it's incurred, and you should probably be able to include that. It's accruing. If my business, let's see, we got that. And this one goes to the replacement issue. I have an employee that is not performing well. Can I let them go and replace them with a different employee for the same position? Again, we don't know. I think for the head count limitation, yes, it would count. For the just actual payroll costs, obviously it's going to count because you're paying them the payroll cost. In terms of the pay rate limitation, we're not sure whether they're going to, because employee number one that you let go is getting zero during the loan forgiveness period. Do you have to reduce it even though you replaced them? I would think the replacements would count, but I don't know. Is a payroll calculated on a cash basis or when it was accrued? We talked about that. Can I prepay leases? We talked about that. Bonuses, 401k contributions, we've talked about that. I think my advice is make as many as you can during this period. And then we'll have to sort out how much of that you can get forgiven. And it's scrolling as I go here. What if you have an employee that wants to be off to take care of kids? We have offered them work from home. And I think I answered that already. Do I still need to pay them? Okay, we've answered that. FTE calculation. How many hours is an FTE? Right now, our profession, the AICPA, is lobbying and saying we should use the same number of hours per week as what was in Obamacare, which is 30 hours per week equals an FTE. We don't know.
Dave,
Yeah,
can I go back to the we have an employee that needs to be off to take care of kids. Well, you don't need to pay them to, you know, regular payroll, but you probably do need to pay them emergency sick leave and expanded family medical leave. And I know that's not our topic today, but if you do that, that will essentially get paid for by the government in the way of tax credits. And so that amount would be excluded from payroll costs for this loan. But whatever you paid the person that the replacement person, then that wouldn't be included in your payroll costs and be forgivable in the 8-week period.
Thank you. Let me scroll down. Will you or do you have a template? So we've done some templates, but as you can tell, what goes into a template is more important than the template. And what are the assumptions? So we're going to have to refine those, but that will be part of how maybe we can help you when we get a little more guidance, and we will have a template, and we will be able to assist you in doing that. I know some banks have already given out templates, but it's, you know, like fill in your total payroll costs and we think it should be this, and it's not much of a help. But some banks who will have templates, we will try to have a template, and that's how we will assist you. Employer portion of payroll, we got that. Health insurance calculation is net of employee payroll deductions. I'm not sure what that means, but any amount that so what you pay your employee contributes to their own health insurance is not your payroll cost. It's only your contribution to the health insurance. So, but if you're paying your employee $100 and you're having $5 withheld as their contribution to their health insurance, you're still going to get the $100 payroll cost, right? That's their salary. So I think maybe that answers it. Who will be auditing these loans? And so who's going to be auditing these loans? The banks have the primary responsibility for getting the required documentation, which we don't know except for payroll tax returns, what those are going to be. But this question number 39, FAQ 39 is saying that the SBA is going to audit any loan over $2 million. And we think that that's more to go back to your certification requirements rather than the detail. I think they're going to leave it to the banks to audit your calculations. For employees who make, okay, so we've talked about that. Employees who make over 100,000, can we bonus them to cover their missing pay? Again, it's not going to do you any good, because I think that's the question. Is that what they're asking, Mark?
I think so, and I believe, you know, if you have somebody who makes 150 a year and you pay them during the 8-week period, your forgiveness amount is only going to be the $15,385, you know, limited to 100,000. But in terms of the money over 100 counting towards the 75% of the loan proceeds, I think that's reasonable, but we're not sure. You know, what if everybody in your firm makes 150? It's possible that you're going to get forgiveness on 2/3 of what you pay. You know?
Okay, where are we here?
You're at we should be somewhere around 10. Using the timestamps.
My thing keeps my keeps like jumping up and down, so it's hard for me to follow.
Right, it's every time.
What if we're not? Okay, so we talked about employer portion of payroll. We did that already. What if we are not allowed to open by June 29th? Well, you can pay your employees to work at home or do training or something like that. That's my best advice. It somehow that's the whole thing about how can I pay them? They're at home, they're not doing anything. I'm going to pay them to do nothing. We'll find out a way of still paying them and have them do something, even though they're at home. I know that's a tough one, but and we're going to provide a template or Excel spreadsheet. We'll be working on that. Is CAM considered rent for the forgiveness calculation? That's a great question. I am not sure. Any ideas, Mark, on that? I would think it's if it's part of your lease agreement that you're required to share in that, and it's part of your occupancy cost. I would lean towards it does, but
Well,
good question.
I think it's going to matter. Do you have a gross lease? Where you just pay a flat rent amount that includes the CAM. Then that's your rent. If you have a lease that spells out, you have a rent obligation and a CAM obligation, and each of the parts of the CAM are spelled out. Chances are Treasury is going to write the rule in such a manner that you only get the part that is labeled rent. And they might even try, like they did with the silly parking rules, 18 months ago, to go back into the lease and try and break it apart. Trying to make every lease a detailed lease. So I wouldn't plan on it, but I'd certainly keep track of it and keep that on the list of things to look at in another week or two when we do get more information.
Yeah, it's like utilities is the way utilities are defined in the act are strange. It even has something about transportation or distribution of transportation is included in utilities. So I have no clue what that means, and so I think we're going to get some guidance on utilities. That's probably another area, and maybe CAM charges could fit into the utilities section, not the rent section. Our business recently applied for EDD's work-share program, which allows businesses to retain employees even though their hours were cut. This happened before applying. The EDD's work-share program picks up the difference in hours that were cut as unemployment benefits.
So what's going to happen is the payroll that you actually pay will be forgivable, but the payroll that EDD pays on your behalf
not going to be a part of your yeah.
Right.
But I don't know how it's going to affect the head count and the pay rate issues. That's another issue too. Because they're picking up that, but you're not paying for it. I think it's gonna hurt you in two ways: in the total payroll amount and in the head count and pay rate.
Right, because it's not the hourly rate; it's the rate per in the pay period. So if last year somebody worked 80 hours in the pay period, and this year it's 30, well, you've got a substantial reduction.
How long does the $600 unemployment insurance weekly supplemental last? I think it's 39 weeks, but I've seen where it's like through the end of the year too.
I believe that the 600 only lasts through the end of July. It was 16 weeks.
Okay.
And I think they extended. This is very confusing because they did they did so many different things with unemployment. They eliminated the 2-week waiting period. They took the standard 26 and extended it to 39 and told the states that that last 13 weeks the feds are going to pay for entirely. And then they added the 600 on top of that. But I think the 600 is only for, currently is only for 16 weeks. Now, if we still have stay-at-home orders in certain states beyond 16 weeks, I wouldn't want to take a bet that it wouldn't be extended. So.
The next question, any truth that the FTB is considering, and the FTB is always considering, but I think what you're probably saying, how is the FTB going to maybe treat the loan forgiveness? And I think I've seen some talk that they are not going to conform and they would tax that, but I'm not sure on that. I'm not sure what the question is, but the FTB is, I mean, to give California the credit, they got out in front of the extension deadlines. They were ahead of the IRS and the Treasury in doing all that. I think our state as a whole got in front of the COVID crisis faster. I mean, kudos to the FTB, but I think they've kind of indicated that they're not conforming to any of the CARES Act rules, but I would suspect that they're going to tax this loan forgiveness, but we don't know. Do you know? Have you heard anything, Mark?
I have not, but I agree. If the FTB is going to tax the loan forgiveness, it would be pretty extreme of them to say, hey, you got federal forgiveness, so we're not going to let you have a state deduction for the payroll. I think it's going to be, I think it's going to stand independently, and you're just going to deduct your costs on your state return and report the income on your state return.
And if the Treasury uses Section 265, the difference between federal and state will be none, because we're going to have loan taxation on California and full deduction on California, and no loan taxation on federal and no deductions on federal. So you can see the silliness of Section 265 being applied here. But
excuse me, Dave.
Yeah.
I just wanted to let you two know it looks like we have still over 50 questions, and it's so if you guys want to maybe pick a few more, it's up to you. I just wanted to let you know in interest of time.
Very good. Okay, I'm just going to scan through if there's anything.
I see questions about, can you use the whole loan to pay payroll? Absolutely. That's Congress would, jump up and down. That's exactly what they want you to do.
Yep. Just be careful you're not butting up against for forgiveness, the 100,000 annualization. And we talked about that, payroll costs, what's included in payroll costs besides salary. It's health insurance. Go ahead.
Employer share health insurance, employer paid state payroll taxes, and employer paid retirement benefits. So 401k match, that sort of thing.
And a lot of these questions I'm seeing here we've answered. So let me just, I'm down at 1032. And that, I think we answered that, kind of what happens to loan forgiveness, even if you believe you're going to suffer diminished returns. So it goes back to when you certified, you used in good faith. I mean, there's certain industries that got hit hard out of the gate, that you had to lay off people and you had to furlough people to survive. And there's some that the uncertainty is going to be on maybe those industries are your customers, and you don't have you can do a work from home thing. You're not going to be affected, but that's going to trickle down, and there's uncertainty that's involved. I think when you got the loan, I think that you were nervous and you were thinking about how soon do I have to make layoffs, and I mean that's a good faith position, even though you weren't at that time, and maybe it turns out you're not going to be as damaged as you thought, but in good faith, I think you can make the case. But again, that's something, I'm not going to be your attorney if you're taken to court on that. I'm sorry, but it's a tough one.
A couple of questions about whether you include independent contractors or quote 1099 employees in your payroll costs, and no, you do not. And the reason for that is they can file for their own PPPL. And then there's a comment that it sounds like we're unclear about the look back period. And no, the look back periods are spelled out. Those were the dates that we gave you earlier. The FTE calculation, though, is unclear because the SBA itself has multiple ways of calculating FTE for different purposes, and so we do need guidance on whether it's a 30-hour or a 40-hour or some other basis.
Can security deposit made be counted as rent?
Nope.
I would say not. It's not an expense. It's going to be, it has to be an expense. So I would say no.
Payroll cost is definitely gross. Your employees' income tax withholding or withholdings for other purposes like their 125 plan, that does not harm you. It's their gross pay.
Sole proprietor, can you deduct health insurance, mortgage insurance? And that's one of the items that right now it appears that no, I mean, if you have employees, you can deduct your employees' health insurance, and a sole proprietor can have employees. So you can deduct your employees' health insurance and mortgage interest and all of that. But if you're a sole proprietor, no employees, the answer is right now, it appears not.
There are several ideas about, can I pay out the accumulated sick or vacation time? Can I pay a retention bonus to myself? All of those things I think we've covered. All we're going to do is come back to the $100,000 or the $19.23 a week or $15,385 for the 8-week limit. So yes, you can pay people extra in the 8-week period as long as it's underneath the $100,000 limit. And somebody's asking about what percentage of the loan is forgiven. Well, it's however the 8-week calculation comes out. There is no magic threshold that if you reach 80%, the whole thing's going to be forgiven, or if you don't hit 75, none of it's going to be forgiven. None of that is correct. It's a pure calculation on what did you spend during the 8 weeks and did it qualify for forgiveness.
And I think the rest of these we've covered. There was a question about a bank. I applied with a big bank. Is there a disadvantage? And I think the thought this is going off topic, but back to the loan application process. I think the thought was the big banks, they had their SBA departments, and they'd be much better suited, and they're ready to go. And what's happened is, in practice, the smaller banks that didn't have the SBA departments tended to be more responsive because they weren't caught up in the processes that they're trying to fit it into. They just ran with the new program. So, but your mileage may vary. I'll just say it's not. It's kind of, that's just a very general observation. But I think all banks are in the same boat. This was thrown at them, and I think they did a great job for the most part, in accommodating people. But I think the ones that had existing SBA programs got more caught up in not being able to adjust to the new. This is not an SBA loan. It's just a treasury loan that's administered by the SBA. That was the confusion. So
I have two quick more questions, or two more questions. One is, they're asking about the payroll taxes on the state payroll taxes being included in payroll costs on amounts over 100,000. And the 100,000 limit only applies to the cash wages, the cash compensation of the employee. So your healthcare is on top of that, your state payroll taxes are on top of that, and the retirement is on top of that. So no worries there. And then there's a question about, is sick leave included or not? And I have to ask the question back, which type of sick leave are you talking about? Because your standard normal sick leave that you happen to pay during the 8-week period is an includable payroll cost. If you pay any of the new emergency sick leave based on the coronavirus, that additional 10 days, that's really all it is to fill in for the first 2 weeks of family leave, is what it's intended to do. If you pay that type of sick leave, it's not included in your payroll costs, and that's because you'll be getting reimbursed for it via your payroll tax returns. So I hope that helps. Looks like we still have 78 hardy souls with us.
Well, congratulations, you made it.
Those are your diehard fans, Dave and Mark.
Yeah, thank you guys. I hope it was helpful, and we'll keep going through some of the questions, and we'll I think some of these questions we'll do a follow-up webinar, right, Jill? I think we're going to have to, and hopefully we'll have better answers.
Absolutely, and it may just turn into a Ask Dave and Mark hour, who knows? So, well, we want to thank all of you for spending your morning with us, and we hope we were able to answer most of your questions. Stay healthy, and we will see you on our next presentation. Bye now.